Uh, Good morning, viewers. See, in continuation of our brief lessons on the that are needed for a examiner examination. Now, after learning about what are the financial statements and how they are, why they are prepared, and all that one. The next lesson I would like to briefly touch upon is the frauds through financial statements. Okay, that is financial statement frauds. See, all the frauds, whether they are related to directly scams or money related or even otherwise, ultimately all involves money. Okay. However, now initially we will be focusing on the frauds that are related or which are repeated to the financial statements. And we know that the financial statement consists of recording of all the business transactions, and then the final outcome is the balance sheet showing the assets and liabilities, and profit and loss account or income statement showing the revenue and expenses, and cash flow statements, where transactions are manipulated in the case of a financial statement fraud. That is in what we have studied. So now one should understand what is a financial statement fraud. It is an intentional act and misrepresentation in the financial statements known as cooking of books. See, cooking of books is what is financial statements fraud. Okay, with the sole intention of deceiving another person or group of persons or general public or statutory authorities or stakeholders or any third party, like a vendor, a bank, or anybody. See, the thing is, cooking of books is done uh, mainly by overstatement of assets and revenues and understatements of liabilities and expenses. Okay, or also at times it may be the under different circumstances the opposite of this one. That is, overstatement of liabilities and expenses and understatement of assets and revenues. Okay, so thus to cover this financial statement is to mainly done to fix a business problem for getting additional advances say, from financial institutions and banks to cover up and siphoning of monies and for window dressing purposes. Window dressing is nothing but showing a position better than what it is. That is called the window dressing. So for these purposes, the financial statement are manipulated, and for the books are cooked up to show the different position than what it is truly. So financial frauds will have devastating effect that will ultimately destroy the company, okay, as well as all those involved. You see, as we see, and you can see from our various other videos on the YouTube, ultimately the persons perpetrating a financial fraud are brought to the book, and the organizations where such frauds are done, in most of the cases, they simply crumble. So that's what happens at the end of the day. So financial frauds occur besides deliberate cooking of books by management for personal gain, not only for personal gain, but also sudden decrease in companies' revenues. Then books are cooked to show better position. Then to show a better position and done for bonus plans, okay, for a management bonus or things like that, and for the opportunities to commit frauds, meaning ineffective board of directors, ineffective internal controls, and wrong financial estimates also will lead to financial frauds at a later date. So financial frauds are committed by showing how by manipulating the books of accounts we said, and that is like fictitious revenues, okay, and then improper revenue recognition, improper asset evaluations, concealed liabilities, incorrect and improper disclosure in the financial statements of all these various things. Okay, so however, what one we should keep in mind always is that always there are red flag or warnings or alerts. Okay, we'll come to that shortly. Okay, which are associated with this? There are signals associated with the fictitious revenue. For example, see, long overdue amounts from debtors, untraceable or outstanding amounts, unusual profitability as compared to other companies in the same industry, too many complex transactions, especially end of the year, high increase in sales volumes over the year. If somebody with a keen eye, the auditors mainly, if they look into these aspects deeply, then there will be an element. Then definitely there will be an element of suspicion will come that there is something wrong with the books of account. So they are called the red flags or warning signals or alerts. And also, apart from fictitious revenues, timing differences, meaning red flags and recording the transactions contrary to timing differences, meaning recording of expenses and revenues in improper periods. That means even though they do not belong to that period, just to bring them into the period to show more profit or less profit, by even though they are do not genuinely pertain to that financial year of 12 months. Okay, that is a manipulating the timing differences, though not related to the period, thus pre or postponing expenses or revenues to shift revenues and expenses on year to year basis is called the timing differences in manipulation of the financial statements. So manipulation of again is there is there in inventory. Inventory is a very big item. So the inventory and sales are played. Okay, inventory, sales, and receivables. That cycle is also manipulated for the showing a position different from what it is, showing a better position than what it is by fictitious entries in these and in the inventory valuation of inventories, okay, and in recording the sales, that is the revenues, and receivables, that is debtors. So this is one of the core area that is uh, cooked up to show a different position, and that involves in the financial frauds. And then so to do that, then getting false confirmation from data balances, and as in the case of Satyam computers or some other fraud cases, even manipulating the bank accounts totally to okay. And so there is no end to it. You see, first you commit a fraud, you commit a wrong, they commit a wrong, and then to cover up, all these documentations are supporting evidence and all are manipulated too. So that's how financial frauds occur. So next is fictitious assets creation with fictitious document support. Okay, so uh, then misclassification of assets, concealed liabilities and expenses. Okay, and so there are big examples which I have discussed in my other video lessons, like WorldCom, Enron, Sachin Computers, Toshiba Japan, where books are cooked up in order to perpetrate financial statement frauds by top management and also with the help of the other people in the finance and accounts departments. And there is a way of detecting also these financial frauds by the internal auditors or external auditors or fraud examiners. Like there is called a vertical analysis, horizontal analysis, and ratio analysis through these mechanisms. Whereas vertical analysis briefly is relationship and comparison of items like income and profit and loss account, balance sheet, cash flows. That is a vertical analysis. Then horizontal analysis, percent of changes from period to period of the balance sheet and profit and loss account. If there are, the changes or the percentages changes is such to create a suspicion. One should go deeper into the theme. Then you manage the financial statement fraud. And ratio analysis is very common. Important ratios like current ratio, quick ratio, accounts receivable ratio, collection of accounts receivable ratio, inventory turnover ratio, average number of days inventory is in stock, debt equity ratio, asset turnover ratio. These are There are several ratios, but among them these are all very important, like current ratio, quick ratio, accounts receivable ratio, collection ratio, receivables, inventory turnover ratio, then debt equity ratio, asset turnover ratio. These are very important ratio analysis. So fraud examiner also can come to know when he has suspicion of all these by interviewing from top management down to the accountant, various people, and then extract information as evidence to support his suspicions, and when he annexes any cooking of the books. Besides all those traditional and standard ways of finding out frauds by these vertical analysis, horizontal analysis, ratio analysis, most important is interview techniques. I think one of the videos I also mentioned about interview techniques, how and what is important in an interview when you are interviewing yeah, any person. Not necessarily he is a thing, but to elicit information, you have to interview people before you come to conclusion that E, A, or B, or C, or X, or Y, or Z is the culprit. And also this interview techniques, as I'm just it should be from the CEO to the COO, CFO, accounting staff, other departmental staff. You have to do all the related parties. You should interview as a fraud examiner or account or an auditor to unearth these financial statement frauds when you get a suspicion. So the prevention part of it means how do we are talking about what are the financial frauds, how they occur, where they occur, how we can get a red signal, and how to go about it. Also, there should be the internal audit. Having an internal audit report or internal auditor is not enough if it is not effective, which is unfortunately in most of the cases. So there should be a thorough, professional, external, internal audit reports that should be taken into consideration, and because there may be some serious allegations or pointing out mistakes or pointing out any deviations in the internal audit report if the audit is thoroughly and professionally conducted, and develop employee personal integrity that within the organization, so that there won't be any chance of any employees down the line perpetrating these frauds. Then reduce situational pressures. That means giving when your somebody is given stiff targets, and if he's not able to achieve, he will do something to manipulate to get his results. Okay, and okay, so stiff targets, and there should be clear cut accounting policies in the first place, not on paper but also in the implementation. So having policy books and guidelines, as I said earlier, in various other contexts is of no use if they are not flown through all the people concerned, explain to them, and then make sure that they are followed and implemented. So that is a most important thing which we don't see happening in many companies. And clear cut decentralization of jobs and accountability. Okay, there should be a clear cut who has to do what is his job responsibility, to whom he has to report, who reports to him, and things like that. There should be clear cutting, and there should not be a one man to do everything. Then most likely that man will commit fraud because everything is in his hands. Then external statutory audits. Okay, these are conducted once a year. So actually, any fraud getting unearthed by external statutory auditors is very remote because they are more like a balance sheet audit, and it's very unlikely that cooking of the books comes out of an external audit. It should come more out of internal audits. That's why there should be a strong internal control and internal audits. And so, to briefly, the financial when we read one of the financial statements, and the financial statement frauds. Okay, this is one aspect of the financial statement. We will go more deeper in the future lessons as we carry on. uh, of how they commit, what are the areas, and what are the ways in which they can be identified at an early date. Okay, and we have studied these things. So with this, we move forward to more deeper into various aspects, more individually, of these financial frauds in the other lessons to come. So I hope whoever is following these lessons is first understood the financial statements, what they consist of, and then next, what we mean by financial statements frauds, what are the areas, how they're done, how they can be prevented or mitigated, and things like that. Then we'll go individually into various aspects of these financial frauds in brief. Thank you.